to the American Dream Connection. I am Amy Atkins, and I'm here with Jason Renno.
First again.
And Mike Meena.
If you're not first, you're last, and I guess I'm last today. I'm kind of sad.
Well, I don't know. I guess I got it wrong this time.
Okay.
But you'll be first next time.
No, I wasn't last time. It's okay. Just continue on.
Well, you know what? You guys stay in touch, stay engaged, because we do this show every week, but the information is always changing, and it's good to always keep up with it. And the market's changing. Do we agree?
Does that say stay engaged but not get married? Is that what you were saying?
Well, you know what? I was engaged for 3 years before I got married.
I was going to say it took me 2.5 years, and
I was good with
get
that.
my wife pregnant to get her married.
Can he say that?
Yeah, it's not the 1950s. You can say pregnant.
Okay, all right, good.
Yeah.
For sure.
All right.
Anyways, great show here for you guys today. We have we talked about earlier today, Dodgers World Series.
The
in
Dodgers.
the World Series.
I know.
Last time the Dodgers were in the World Series, 1988, and interest rates were 10.3.
I'm not
taking my hat off.
Yeah, rates were
You just do
10.34%.
this. Yes. Wait. What were rates?
10.34.
Holy cow.
1988.
Yeah. Don't be
Kirk
complaining
Gibson's
about
home
rates
run.
right now. Don't be complaining about rates right now.
Okay, yes.
All right. So let's talk about markets, because a lot of people don't know what is a normal market and what isn't. So in a seller's market, just so you know, in a seller's market, that is less than 6 months inventory of homes out there to be consumed by those that want to
So what
buy.
do we have today?
So we're looking at a neutral market, which is 6 to 7 months of inventory. Okay. A buyer's market is greater than 7 months worth of inventory. Okay. So where do you think we're at?
I think we're at 5 months.
You think we're at 5 months? Well, that would put us.
No, we're not
No.
even. No,
Yeah,
we're
we're
not
not
even.
there.
No,
No.
we're probably at 3 months.
Okay. So we're still not at the level that would cause people to panic that there's too much on the market. Okay. So we're still looking at it being a seller's market, kind of going into more of a neutral market. But if you look at the numbers, we still have a long way to go. And with interest rates, we still have a long way to go. So today, let's weigh in on like the first time buyer thing and what's going on with that, because I know people
Okay,
really wanna know.
so here's what's going on, okay? First-time buyers move this market. That's just what it comes down to. So we have to have a really good understanding of what a first-time buyer is all about. To me, if I take a first-time buyer, let's say we can get them up to, say they make $1 million a year. We can get them a zero down loan at $470,000. It's a first and second mortgage combination. Just call us and we'll tell you about the loan program and everything like that. But let's say we get that buyer at that level. $470,000, zero down, their total payment, principal, interest, taxes, insurance, the whole 9 yards, $3,100 a month. The good news is they're going to pay off $400 in principal. Is that right? Oh no, it's $3,650. $550 in principal. $400 is a first-time buyer credit if they qualify for the first-time buyer tax credit. Then, if they have appreciation of 3% annually, okay, they'd have $1,175 come back to them. Or if they have 5% annual appreciation, it's $1,958 back to them. So you're looking at a client like that and you're going, okay, look, dude, first-time buyer, Mr. Person, whatever you are, you'd be paying $742 a month with 5% appreciation on a zero down loan in comparison to the rent that you're paying today. So to me, it's a no-brainer. You could look at the 3.5% down, you could look at the 5% down, or you could wait until interest rates go up another 1%. What happens? Payment jumps up $300 a month, $275 or something like that.
Yeah, at least depending on the purchase price, right?
Right. So first-time buyers, get off the fence.
It's driving me nuts because everybody's going, oh, interest rates are higher, they're high, or they're higher, and I'm getting so frustrated with that word. It's like, they're not high, they're not higher, they're just normal.
Yeah.
The government economy is doing good. The government is not pumping in $1 billion, $20 billion a month worth into the mortgage-backed security market and artificially keeping interest rates low, which frankly shouldn't happen. I mean, everybody's making more money, so yes, interest rates are going to be higher, and it's all relative. You can walk into a bank now and get more than 0.5% on your CD, or you're getting good rates of returns on your 401k. I mean, everybody freaked out, what was in 2008 when their
0.5% in my interest rate or whatever.
Mm-hmm. Everybody freaked out when their 401k got cut in half, or not cut in half, but they lost it. But then they weren't freaking out because they went and bought a house with a 3.5% interest rate. So it's a give and a take in 6.5 or 5.5, whatever the interest rates are, or they're going to be, is very normal right now, and that's what we need to get a grip on. And frankly, everybody's watching their 401k, but nobody's complaining about that, right?
You want to hear a cool number?
Sure.
Yeah.
I didn't tell you guys this. There is $14 trillion in equity in people's homes right now. $14 trillion. You know what's going to happen? A lot of people are going to tap into that because we spend too darn much money. So, but that's a big part of the market. But rates are still fantastic. Be careful with your home equity lines of credit too, because those rates, keep in mind, if interest rates climb, let's say for instance you have that 3.5% or 4% fixed rate, and you want to pull out 100 grand or 200 grand or 300 grand or 600 grand or whatever it is, be careful with those home equity lines, because yeah, they might look good right now, 1% over prime, it's 5.25 or something like that, or 5.5, whatever it may be. Be careful, because those things will go boom, 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 and before you know it, you'll be paying 7, 8, 9% on a home equity line of credit. I know that pool looks great. I went in my pool like 6 years ago. Do you have a pool?
I do, yeah. I put one in last year, and it's amazing.
Do you like it? Your
did,
kids
yes.
are younger than mine, though.
Yes, they are
Do you ever
younger.
go in your
and
pool?
then,
I do.
Do you?
Yeah, I do.
Wow,
Yeah,
so that's
I do,
cool. I don't.
So I read too that 40% of the population that owns homes are in a positive equity position.
Yes.
So how does this different than in
40% in a positive equity? That sounds shocking.
yeah,
But it's a bad market. It's a bad market right now.
40%
The
of
bubble's gonna
homeowners are in a
crash, right?
positive equity position. So how does that make us different than back in 2006, 2008 when what everybody's fearful of?
Well, when the market crashed,
Mm-hmm.
first of all, I think that number's low. I think it's got to be 80 or 90%. I mean, anybody who's bought in the last 7 years has to be in a positive position here in California.
And then with lending
So
restrictions,
California's different.
we're not lending 117% of appraised value. So it's
No.
yeah. I mean, anybody
Yeah.
that's purchased.
So here's the difference. Here's the real difference, okay? Let's say, for instance, the market's even to where it was 10 years ago, okay? And let's say you buy a 3-bedroom, 2-bath house for $500,000, $550,000, whatever it may be, okay? And back then you were getting a 6.5%, 7% interest rate when you're 3.5% down. And then when you lost your job or something else bad happened and you had this $4,200 mortgage payment, guess what you could rent your property for?
What?
Like $1,800, $1,900 a month. So today, that same 5.25, okay, first of all, your payment's much lower, and you're probably renting it for $2,800 to $3,000.
Does it make sense to buy a property and continue?
But what you're saying though, if what you're saying is true, which I wholeheartedly think it is, or I think Mike is hitting the nail on the head where you're underestimating the numbers. Where I was doing
That's
this.
good. No, that's cool.
You like that?
It was.
40% in positive equity. Back when the bubble bursted in 2008, 40% of the people, I think it was technically 20-something%, but let's just say 40% were behind on their payments. Were 60 days behind on their payments, 90 days, going into a foreclosure proceedings where they couldn't afford the property. There definitely was not an equity position.
Here's what'll happen. If the market adjusts, say 20%, how many investors do you think are going to jump in on that? They are going to freak and jump in, because if you can get a $500,000 house for $440, okay, that's 12% off. Okay, boom. All of a sudden, I turned a 7% cap rate, and we'll get into cap rates down the road, into a 9% cap rate, and I'm like, boom, let's go. I'll take that stinking thing. I'm going to make money hand over fist. If you look at what you make in real estate, the return on investment is absolutely ridiculous. If I took 20% down today to buy an apartment building, let's just call it $1 million apartment, and I'm getting $6,000 in, well, you'd probably be getting $6,000 in net rental income every single month or something like that. It's paying off the mortgage, it's giving you cash flow, it's giving you this, it's giving you that, and it's paying you on that 20% down, probably 12, 13% annually with zero appreciation. You get the appreciation, it jumps up to 18 or 19% at a 3% appreciation.
And you have a fixed cost.
Right, and I'm running these numbers off the cuff, but call us if you really want to know how these numbers look. If you're thinking of buying a 2, 3, 4 unit, just even one house, single family condo, beach house, whatever it may be, to me, understanding the numbers and understanding what you're doing, hey, guess what your return on investment is on a new pair of shoes? Okay, 0.
It's true, they wear out.
They look
Yeah.
good though. Come on, they look good.
I bought a new pair of shoes. I get them on Nordstrom Rack. They're here.
Wow, those
They're
are
nice, aren't they? Brand new.
I like
first
the
time
socks
today.
too.
It's all about the Americans.
You're
I'm
known
surprised
for
you don't have
something.
Dodger socks or something.
So
I
no,
know,
I don't
right?
have. I have Lakers and Rams, but not Dodgers. I got to get some Dodgers.
Okay, so here's a question we get a lot, so I'm going to ask it to you guys for our good viewers out there. I'm a first-time buyer, and I'm thinking, I don't want to do anything right now. I think I'll just wait till next spring. What do you have to say about that?
I say it's going to cost you more money.
Okay.
That's for sure. I mean, if 5%, 5.5%, 30-year fixed, you go and jump into a 6.5% 30-year fixed, which is not that unrealistic for next spring. I mean, we're talking April, May of next year. Yeah, I mean, it's going to cost you what, 10% more, 1% increase in interest rate. So if you can qualify for 500,000, now not only our home prices will slowly go up, but now you're going to 500,000 easily turns into 450-ish, 470-ish in terms of your qualifications. So now you just knocked yourself out of a big portion of the market, and not to mention you didn't get the tax benefit for the last 6 months.
Well, the other thing that's worrisome is where the market's going to be next spring. And if the rates are going to continue to rise, we've seen the market explode every spring. And that's always a scary thing. And then what happens? Our inventory shrinks, we get multiple offers, we're now overbidding on prices of houses. And it's always scary for buyers to jump into that market.
Correct.
The affordability's already not great, okay? Imagine what it'll be in the spring if we have another 3 to 5% increase, and then we have another increase in the interest rates. Oh my God, what could happen? So, do I think rates are going to go crazy? I don't think they're going to go as high as you think they're going to go. I think 6% by the end of next year is probably realistic, but I also think that the values can continue to rise. And again, investors are there. Where else are we going to put our money? The stock market looks like it's inflated too.
Yeah, that just obviously depends who you ask. And I mean, I don't necessarily think interest rates will go to 6.5%. I'm just trying to,
I just want to be right, dude. It's totally okay.
It's all good.
Go back on your word.
You can always be right. You're the boss, so it's all good.
Well, I think you guys answered the question, and we're going to wrap it up here because I know both of your phones are blowing up right now with calls coming in, and I know we got to get to them. So thank you so much for watching. Make sure you share this with someone, because I hear it all the time. People go, I think I'm going to wait. Don't wait. Two great brains here in the business just told you reasons why you should not wait. So feel free to share this video, like this video.
2 heads are better than one, right?
2 heads are better than one. Yeah, no, I'm just
share the scare. I don't know what it is.
So make sure that you share this video with clients, with friends, or whatever, anybody that wants to know more about what's going on in the market, because we are the American Dream Connection, and we want you to stay connected.
American Dream Connection.
Sorry guys, I don't sing.
Me neither.
I wasn't singing.
We'll see you next time.